There's a strange kind of grief that doesn't get talked about enough, and it has nothing to do with losing a person. It's the grief of losing an era. Specifically, the era where borrowing money was cheap. If you bought a house, financed a car, or even just carried a credit card balance back when interest rates were near rock bottom, some part of your brain quietly filed that away as normal. That was the baseline. That was how the world worked. And now, years later, that world hasn't come back, and a growing number of people are starting to suspect it might not come back anytime soon. Here's the part that catches people off guard. It's not just that rates went up, it's that everyone kept waiting for them to come back down, the way you'd wait for a storm to pass, and instead, the forecast keeps quietly getting pushed further into the future. Higher rates for longer isn't a temporary inconvenience anymore. For a lot of people, it's starting to feel like the new climate. So today, let's talk about why this shift messes with people's heads so much more than the actual math would suggest, and more importantly, what to actually do about it. So you're not just sitting around waiting for a world that may not return. Here's the quiet assumption a lot of people have been carrying around. Rates are high right now, but eventually things will go back to normal. It's an understandable thought. We tend to treat whatever we experienced first, or experienced most vividly, as the default setting for how the world works. If you bought your first home, or took out your first loan during a period of unusually cheap borrowing, that period doesn't feel unusual to you. It feels like the baseline. Anything above that baseline feels broken, temporary, something that obviously has to correct itself eventually. But here's the uncomfortable truth hiding underneath that assumption. The era of extremely cheap borrowing wasn't actually the historical norm. It was closer to an unusual stretch, brought on by very specific economic conditions. What feels high to a lot of people today is, in a longer historical view, closer to ordinary. This mismatch between what feels normal and what's actually historically typical creates a very specific kind of financial anxiety. People keep making decisions as if relief is right around the corner, delaying plans, refusing to adjust their budgets, holding on to debt at a certain rate, while waiting for a refinance opportunity that may not show up for a long time. And that waiting has a cost, even when it doesn't feel like one in the moment. Let's break down what's actually happening, and why it affects your daily financial life more than most people realize. Here's a simple way to picture interest rates without getting lost in jargon. Think of interest as the price of borrowed time. When you borrow money, you're essentially asking to use someone else's money now, instead of waiting until you've saved it yourself. The interest rate is simply the fee charged for that convenience. When that fee rises, it doesn't just affect mortgages. It touches almost every corner of financial life. Car loans become more expensive. Credit card balances grow faster if they're not paid off. Even renting can be affected indirectly, since landlords often carry their own loans on the property, and rising costs tend to trickle down. At the same time, something quietly improves on the other side of the equation. Savings accounts and safer interest-bearing accounts often start paying you more for simply holding your money there, since lenders are now charging more across the board. This is the part that surprises people. A higher rate environment isn't purely bad news. It's a shift in which side of the equation rewards you. Borrowing becomes more expensive. Saving becomes more rewarding. The challenge is that most people's financial habits were built during the opposite environment, where borrowing was cheap and saving barely paid anything at all, so the instincts formed back then don't automatically update just because the environment has. Here's a psychological pattern worth understanding, because it explains why so many people get stuck. Humans have a strong tendency to wait for ideal conditions before making a decision, even when waiting itself carries a real cost. This shows up constantly with interest rates. Someone might delay buying a home, thinking, "I'll wait until rates drop." Someone else might avoid paying down a loan aggressively, thinking, "There's no point, I'll just refinance once things improve." On the surface, this feels like patience. In reality, it's often just a more comfortable form of avoidance, because waiting requires no immediate action, while adjusting a budget or making a financial decision under uncertain conditions requires effort and discomfort right now. Picture someone standing at a bus stop, certain the next bus will arrive any minute, refusing to start walking toward their destination because surely the bus is close. 10 minutes pass. Then 20. They're still standing there, because walking now would mean admitting the wait might be longer than expected. Meanwhile, someone who simply started walking the moment the wait felt uncertain is already partway to where they needed to go, regardless of whether the bus eventually shows up or not. This is exactly what happens with interest rate predictions. Nobody, not professional economists, not banks, not the most confident voice on financial news, can reliably predict exactly when rates will shift, or by how much. Building your financial plan entirely around a specific guess about future rates means building your stability on top of a forecast that even experts get wrong constantly. Here's another layer that quietly makes this harder than it needs to be. A lot of financial frustration around interest rates doesn't come from the rates themselves. It comes from comparing your current situation to someone else's past situation. Maybe a friend bought their house years ago at a dramatically lower rate, and now every time you think about your own mortgage or loan, that comparison creeps in, making your own numbers feel unfair, even broken. This comparison is understandable, but it's not actually useful because you're comparing two different economic eras as if they were the same playing field. It's a little like comparing the price of milk today to the price of milk decades ago and feeling outraged that it's gone up so much. The comparison feels emotionally real, but it ignores that the entire system shifted underneath both numbers. The healthier comparison isn't what would this have cost a few years ago. It's given where things actually stand right now, what's the smartest move available to me today? That single shift in framing, from grieving the past environment to operating clearly inside the current one, is often the difference between feeling stuck and actually moving forward. Here's the deeper idea tying all of this together, and it's the part that genuinely changes how people approach money during periods like this. Higher rates for longer isn't really a story about interest rates at all. It's a story about how much financial stress comes from waiting for a world to return rather than adapting to the world that's actually in front of you. The actual math of higher borrowing costs is real and worth taking seriously. But a huge amount of the emotional weight people carry around this topic comes from refusing to update their mental model of what normal looks like. Think about it like adjusting to a new climate after moving somewhere with different weather. If you keep dressing for the climate you used to live in, every single day will feel uncomfortable, and you'll spend your energy complaining about the cold or the heat, instead of simply adjusting your wardrobe to match where you actually are now. The discomfort isn't really about the weather. It's about the gap between expectation and reality. Money works the same way. People who treat the current rate environment as the actual terrain they're standing on, rather than a temporary detour from some better terrain that's coming back, tend to make calmer, more effective decisions. They're not necessarily happier about higher borrowing costs, but they stop wasting energy waiting for rescue and start using that energy to navigate conditions as they actually exist. This is also where the saving side of the equation becomes genuinely important. In a higher rate environment, money sitting in a strong savings or interest-bearing account is quietly working harder than it used to. People who stay mentally stuck on how expensive borrowing has become often miss this other half of the picture entirely, the fact that patience and cash reserves are being rewarded more generously right now than they were during the cheap borrowing years. The same environment that punishes debt also rewards discipline, and that's a trade most people don't realize they're being offered. So here's what to actually do, practically, if higher rates are sticking around for a while. First, stop budgeting around a guess about the future, and start budgeting around the present. If a loan or mortgage payment is genuinely uncomfortable at today's rate, the plan shouldn't be wait for relief. The plan should be adjusting spending, building extra income, or restructuring the loan now, based on the reality you're actually living in. Second, take advantage of the side of the equation that's currently working in your favor. If you have savings sitting in an account earning very little, this is a good time to compare options, because interest-bearing accounts are often paying meaningfully more right now than they did during the cheap borrowing years. Letting cash sit idle in a low-yield account during a period like this is one of the easiest, most overlooked opportunities to quietly strengthen your financial position. Third, prioritize paying down high-interest debt aggressively, especially anything tied to a rate that moves with the broader market. In a higher rate environment, the cost of carrying a balance compounds faster than people expect, which means the psychological relief of, "I'll deal with it once rates drop," often ends up costing significantly more than simply tackling it head-on now. Fourth, separate big decisions from emotional fatigue. Large financial choices, buying a home, taking out a major loan, refinancing, deserve to be made based on your actual needs and numbers, not based on frustration about how different things used to be. If a decision still makes sense at today's rate, after running the real numbers, it's worth making. If it only made sense at yesterday's rate, that's useful information too, but it's not a reason to freeze entirely. Fifth, give yourself permission to stop waiting for a forecast no one can reliably give you. This doesn't mean ignoring future possibilities. It means building your plan around what's true today, while staying flexible enough to adjust if conditions genuinely shift later. Flexibility, not prediction, is the actual skill worth developing here. Here's the idea worth carrying forward. Higher rates for longer isn't a punishment, and it isn't a sign that something has gone permanently wrong. It's simply a different set of conditions, one that rewards different behavior than the conditions a lot of people got used to. Borrowing costs more right now. Patience and savings are being rewarded more generously in return. That trade isn't necessarily worse. It's just different, and different requires an updated map, not an old one held onto out of nostalgia. The people who navigate this period well aren't the ones who correctly guessed when rates would change. Nobody reliably does that. The people who navigate it well are the ones who stopped waiting for an old world to come back, and instead got genuinely good at moving through the one that's actually here. So the next time you catch yourself thinking, "I'll just wait until things go back to normal," ask yourself a more useful question instead. What if this is normal, at least for a while, and what's the smartest move I can make inside of it, starting today? Because the goal was never to outguess the forecast. It was always to keep moving, regardless of which way the weather turns.